Good day, everyone, and welcome to today's Global Macro with the King of Waves. Today is 3rd of March 2026, and we are going to be looking at the forex market together like our usual practice. And the essence of that is so that we can know uh, which of the assets are we going to be focusing on in the course of the week into next week as forex traders. And of course, I remain your host, Mr. Kimbode, the King of Waves. I'm the lead analyst at Potential Miners International, a research platform that is dedicated to conducting researches at different levels so that we can identify and harness potentials for our best interest. So today I'm going to be diving deep into the analysis. I don't want this video to be very long. I'm going to be starting with the fundamental analysis. Of course, like our usual practice, we usually analyze the market from different perspective, the fundamental perspective, the sentiment perspective, and of course, we look at the technical storyline. So today, let's quickly dive in. Let's see what we have from the angle of the fundamental standpoint. What is happening? And when we say fundamental analysis, I want you to really know that fundamentally, the forex market or the financial market can be analyzed, looking at indicators of the economic standpoint of different countries. And of course, you can also look at the geopolitical happenings. But because our analysis incorporates sentiment analysis, and we believe that whatever geopolitical happenings that is going on at any moment will be factoring into the sentiment overview of the market. That is why when we say fundamental analysis, we strictly focus on the economic standpoint, and our metric of analysis is the interest rate. Our metric of analysis is the interest rate, and this is because we have overviewed the market over 6 years. We notice that what is most important when it comes to forex market is the interest rate standpoint, interest rate decision, or interest rate projection. And every other economic indicator dovetail into what the interest rate is going to look like, or whether the decision makers are projecting to change the narrative of the interest rate at any future time. And this is why when we come to the fundamental analysis, we want to quickly look at what is the standpoint of the interest rate, and we will look at the week. Do we have any event or news event coming that can change the standpoint of the interest rate? Between last week and this week, not very much changes as a core when it comes to interest rates. For the Australian dollar, the interest rate still stands at 3.85. GBP, which is the Great British Pound, the interest rate stands at 3.75. United States dollar, the interest rate stands at 3.75. Canadian dollar 2.25, as well as the New Zealand dollar, and of course the euro stand at 2.15, while the Japanese yen is standing at 0.75 as against the Swiss franc, which stand at 0.0. And this is important because when it comes to the forex market, one of the focus of the investors is to see how they can leverage on divergence of interest rates and make money for themselves in the global market. So what the divergence will enable them to do is they will be able to get fund from a particular country with a very low interest rate, and they can now move down those funds and do or engage in a kind of investment in bonds or treasury bill of another country with a very high interest rate. And this is what we call carry trade. I beg your pardon. This is what we call carry trade, and this is very central, and it's just a normal thing for an average investor. You want to make money. Where are you going to get your capital from? At what rate are you getting the capital? Then where are you investing the capital? At what rate will you be expecting a return on that particular investment? So this is what the interest rate divergence is tracking, and it's very central, and it determines to a large extent the template or the flow of capital in the financial on the global financial market. So having said this, the overview of the interest rate at Potential Miners International means that for our listing of assets that we will be looking at, we want to list assets with a very wide interest rate divergence. What that means is that, for instance, as we have Australian dollar to be 3.85, we want to be pairing Australian dollar with currencies like Japanese yen. We want to be pairing Australian dollar with Swiss franc, from the interest rate standpoint. And of course, the same thing goes for Great British pound. We want to pair it with the Japanese yen. We want to pair Great British pound with euro. We want to pair US dollars with euro. We want to pair US dollars with Japanese yen. And of course, we want to also pair US dollar with the Swiss franc. This is very important. It's very important because what you are to leverage on or bank on as a forex trader is the possibility or likelihood of a clear trend in the particular asset or commodity that you will be trading. And this is where the divergence in the interest rate comes to play a very significant role. So having said all of that, on the list based on the fundamental analysis, we know that if we are picking currency from the highest ranking, we'll be picking AUD, GBP, and USD. Then we will now be pairing these currencies with Swiss francs, CHF, Japanese yen, JPY, and possibly euro. You get that now? The top three currencies and the top lowest currencies on the ranking of the interest rate. These currencies or pairs of these currencies, they have high tendency or likelihood. I want you to take note of my choice of words. They have high likelihood to give us a very clear trend, whether to the upside or to the downside. But because the forex market is also influenced by a lot of factors, a lot of happenings, we don't want to base our decision of what to trade on the fundamental standpoint as captured by the interest rate divergence. We still want to move our analysis into what we call sentiment analysis, and that is where we look at the global market, and we overview the risk template of an average investors from the global macro perspective. And that's the next phase of our analysis. I'm going to quickly go into that. If you are seeing this video for the first time, this is a video, or this is what we call global macro with the king of wave. Is a weekly analysis that will come out at the platform to dish out to the general public, and this is to encourage an average forex trader to start to look at the market from a global macro perspective. You don't just want to get to the forex market and begin to take a position of to buy or to sell or to pick a particular currency pair without having a very strong fundamental or sentiment rationale for your choice of assets. And this is why a lot of the time, forex traders, they are at times gamblers, because they just come to the market, they sit down in one corner, maybe in their room or in one of their offices, and they want to feel like I can predict where this particular asset is going to go to, without any global standpoint backing their conviction. So we want you to begin to look at the forex market as a global market, not a market that is showing you candlestick that is going up and down. It's a global market, and we have big players in this market. So if you really want to do this for a long time, you really need to take your analysis serious, and you must allow your analysis to reflect the template of how the big players, the big banks, the hedge funds, how they look at the market. And of course, an average big bank or hedge fund will be looking at the market from the global macro perspective, considering the fundamental standpoint, the interest rate differences or divergence, and of course the sentiment of the market at any point in time. Then they will now look at the technical analysis to position where do we have a major liquidity pool, where can we position our trade. So the same thing is what we are doing here every week. We come out to look at the market together, then we make the video available in days that we cannot do a live video to analyze the market together. So, and today is one of those days we were not able to we were unable to record a live video or to live stream. So this is a recorded video, and of course our analysis still stand valid, whether it's a live stream or a recorded video. The essence is for you to be able to know what are the assets that I'm going to be looking out for in the week, or in this week into next week. So without further ado, let me just move straight into the sentiment analysis. At Potential Miners International, when we get to our sentiment analysis phase, we ensure that we overview different indices. And the essence of this is so that we can have a very robust conviction as to what is the risk sentiment of the global market. And of course, we have 5 different indices that we use to gauge at any point in time what is the risk sentiment of the market. And the first one is the S&P 500. S&P 500 is the index of the top 500 companies in the United States, and this is showing us to a large extent if this particular index is given a predominant bullish structure. It means that investors, they are ready to put their money on the line, and there is no panic in the market. You will notice that over time it has been maintaining since May 2025. May last year, it has been maintaining a steady upward bullish movement, and of course that replicates, or that interprets, or that connotes that there is a risk on over time. But today, as of today, let's see what we have. Considering the Middle East crisis or war between Iran and the United States / Israel, you can see that there is a level of panic on the global level. So, and this is reflecting on the S&P 500 index. I said it that if the index is trading above the cloud and is predominantly bullish, you say that there is risk on. Risk on means that there is no panic, there is a level of stability, and there is confidence in the mind of an average investor to put their money into different assets that can get them the maximum return. But when there is a risk off, or let me say when the index S&P 500 is trading below the cloud, this particular cloud, it indicates that there is a level of fear in the market. And if there is a war between Iran and USA, these are big economy, and anything can happen following this war. If care is not taken, it can lead to a regional war. You will see that the UK, they are already in alignment with the United States. They are saying you can use our facility to position for an attack on Iran. Before you know it, it will lead from that war, it will lead to a lot of destruction in the value chain globally, and this is going to disrupt a lot of economic activity. As we speak today, a lot of airlines have already shut down, losing millions of dollars. So this is reflective in the approach or in the template of the stock market. And S&P 500 is telling us that the price is right about now. Today is 3rd of March 2026. the index is below the cloud and is giving us indication of a risk off. But because we want our validation to be very robust, we still use other indices to validate whatever the S&P is showing us, and we have the Dow Jones Industrial Average. This is the average of 30 industrial firms in the United States, and this particular index is like, a validation for S&P 500. If S&P 500 is selling predominantly and the Dow Jones Industrial Average is selling predominantly, we can be rest assured that there is a template in the market that is showing us that investors, they are panicking. So everybody, they are withdrawing their money, locking it in safe haven, as it were. You see it now. So the S&P 500 is below the cloud. Now we can say that we are in a risk off. The Dow Jones Industrial Average is below the cloud, is almost below the cloud. We can say that we have a clear risk off. Let's continue because we have 5 of these indices. Now, since last week, the Nasdaq Composite Index has been showing us that there is a template of risk off, but we could not follow what Nasdaq Composite Index was telling us as of last week, because both the S&P 500 and the Dow Jones Industrial Average, they are still trading above the cloud. But today we have clear signal that at least 2 of these indices, these stock market indices, they are clearly below the cloud, the S&P 500 and the Nasdaq Composite Index. And of course, if what we have continue, the Dow Jones Industrial Average between now and tomorrow will still be clearly below the cloud. So this is telling us that from the standpoint of the stock market on the global level, we have a risk off template. And this is very central for what or where capital will be flowing into in the market predominantly between now and next week. So, but because we still want to look at other vital, standpoint of the market as to if there is this fear, how deep is this fear? We want to see. So we still have 2 other indices that we use to gauge the standpoint of the risk sentiment, and the 4th one is the volatility index. Like I used to say, once you have the volatility index above 20, is signaling that there is a level of panic. Now, if you now have this backed up by the stock market indices showing you a bearish structure, then is a confirmation that we have a risk off in the market. And that is what is playing out today. The volatility index of S&P 500 is right above 20 at 26.44. This is huge. And this is showing us that there is a clear fear on a global standpoint. So it means that an average investors, the big players, people that have the resources, they want to consider pulling their fund or capital from any high risk commodity into safe haven. That is the template. When we say risk off, it means people want to err on the side of caution. That is what risk off means. Are you getting it now? So, excuse me. So let's just continue. That's just a destruction from our hand. The solar system was giving me a signal that we should put off some of the load on it. So, but then let's just continue with the analysis. I want to believe that everything is still intact, and I can wrap up and show us what and what to look out for when it comes to some of the assets in the market. So, having said this, let me just quickly go back. And okay, having said this, we have looked at the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite, and we have looked at the VIX, the Fear Index. Then let's look at what the king of the market is saying. Right about now, the template of the market now is now telling us that dollar is back as the king. So, dollar being the king of the market is now trading above the cloud. This means that dollar is gaining strength now, and that is expected, because when there is panic in the market, people want to, at least there is a stable economy, that if I still hold their currency, I can still be guaranteed that whatever will happen, I will still not lose greater part of my value. So people are now, if you will notice that currently, by the time we get to gold, you will notice that people are not even buying gold. People are now putting their capital into dollar. You can see now. So the conclusion from our sentiment overview is that there is a risk of template. So today, 3rd of March 2026, the risk overview or risk sentiment of the market is risk off. What this implies is that by the time we get to some of the assets, you will begin to see this. What this implies is that capital will be flowing predominantly from high yield commodities, or high yield currencies, I mean to say, into low yield commodities or safe haven commodities, expectedly. So let's now quickly go, because of time, let's go into what we have. Let's quickly see what do we have in the market. I'm going to look at a few of the assets on our major, and if I can check the minor, we'll do maybe one or two assets. So let's start with gold. In fact, a lot of forex traders, they are surprised as of now. They are surprised what is happening to gold, because if you have a risk of sentiment in the market, it is expected that investors will be buying commodities like gold. But for now, gold is just dipping. We don't know what is happening at the moment. But obviously, the expectation on gold as of today, 3rd of March 2026, is that we still expect gold to give us a push up to the upside. Why? Because we have a risk of sentiment. Now, the reason why gold might be doing this might be because over time, dollar has lost its value, and because of this, Middle East crisis and the war that is currently going, it was around this time that dollar is now gaining back its value. So a lot of capital is being drawn to dollar instead of gold. You get it now. So this might likely be the reason why at the moment gold is selling. But when you have risk of sentiment in the market, you expect that gold should be pumping very hard to the upside. You get it now. So it means that from now into next week, we are still expecting a push up on gold. All other things held constant. But as of now, gold, you cannot buy gold as of now. Why? Because the market structure and the market structure on the daily is showing us a bearish structure. So you have to wait for gold to turn and give us a bullish structure, especially on the daily. Note that you will have to consider that we still have the directional bias on gold on the weekly to be a buy. So we are still expecting a buy on gold. However, for now, we are going to stay put, because currently the daily structure is showing us that gold is dipping and we cannot buy for now. Meanwhile, we are not going to sell. Why? Because the directional bias is still a buy. That's how we trade at Potential Miners International. In fact, because of the analysis of the fundamental, we took a trade based on our signal. I think it was yesterday, and gold decided not to move us to the upside, and we lost that trade, and that's the only trade that we have taken for this week. So but we are still going to position for maybe one trade if we can see opportunity in the market for the week, and we are going to recover that. But especially on gold, you are to stay put and be looking out for a buy on gold. Why? Because the risk template of the market on a global scale is risk off, which means that people will be looking for how to lock their money in the safe haven. You get that now. So let's move quickly to BTC. You see, BTC has been selling over time, and I said we want BTC to correct. So we are waiting for correction of BTC to maybe something like around this place before it dumps to this side again. So we want BTC to correct to somewhere around this place. Yeah, somewhere around this place. So before we expect it to dump down. So BTC is still coming to plus or minus. BTC is coming to around 53 dollars plus or minus. You get that now. So that this is our expectation on BTC. So it means we are positioning for a sell on BTC. We are not going to be entering the buy because there is no even buy opportunity on BTC yet. So we are positioning for a sell. So just wait for BTC to correct itself, then give you a clear movement to the downside, then you can position for a sell. Let's see if we can do one or two. Okay, let's see, what do we have for okay, let's do Euro USD. Now, because the strength of dollar is back now, you are going to be expecting a sell on Euro USD. Let me repeat that. When dollar is buying, because euro and GBP, they are anti-dollar, they are dollar aversion currencies. So you are going to be expecting a sell on euro. So, but for now, our directional bias is still on the buy. So we'll wait for Euro USD to close below the cloud. So before we can start to sell Euro USD, we still want it to come down a bit. It's still going to push down a bit till you have it below the cloud on the weekly. That's how we trade at Potential Miners International. We must be certain of the directional bias. So this price must still close below the cloud on the weekly before we can take a position for a sell on Euro USD. You get it now. So let's see what we have for USD JPY among other JPY pairs. So USD JPY, you notice that both USD and JPY, they are safe haven currencies. But because USD is gaining its strength back now, so a lot of capital is flowing into USD, as much as capital is also flowing into JPY. You will notice that if you go to the 4 hours, while other JPY are selling, USD JPY has been buying. Are you seeing it now? That is to show you that the movement of the candlesticks is just the flow of the capital on the global scale. You get the gist now. So if you want to really trade the market for a long time, you need to start to understand why capital will be flowing at any point in time to some set of currencies, and whether that flow is going to be continuous over time, and then you begin to position for trade. So for USD JPY, we are going to be positioning for a buy trade. The directional bias is still a buy, and on the daily we have the clear market structure to be a buy, and the price is now above the cloud. So for between now and next week, we are going to be expecting USD JPY to give us a correction to this place, something like this. Then we are going to push it up like this. All other things held constant. Are you getting it now? So USD JPY is one of the pair that we'll be looking out for a buy between now and next week. Don't forget that the interest rate divergence between USD and JPY is very wide. So once the war or the tension, as regard the war between USA and Iran settle down a bit, USD JPY correct is going to now push up to the upside because capital will still flow away from JPY sooner or later. Now that USD is now having a lot of strength as against what happened last week and in the previous week, we will be expecting that USD JPY will be pumping to the upside, and everything is aligning in the direction of a buy trade. So we are expecting USD JPY to come to, to this to this area. USD JPY should come to area of 161.90 plus or minus 161 or 160, around this area. This is where we are expecting USD JPY to come to. Yeah, around this area, 162, or let's say 161.95. So we still have a lot of space to the upside. You can see that. You can see this now. We still have this space to the upside for USD JPY. So we are still going to take trade, on USD JPY. You just stay put. You don't need to rush yourself. Whatever the market is ready to give you is what you should take. Don't force the trade, because eventually you cannot force anything. So I want to believe that listening to me and hearing me analyze the market like this, should I believe that you should have a change of mind as to how you approach the market. You don't just want to get to the market and begin to buy and sell. You sell anything that looks like it's going down. You buy anything that looks like it's going up. No, you can't trade like that. In fact, the reason why a lot of traders trade like that is because they don't have enough of capital in this market. I want you to, from today, begin to imagine that any trade you enter is 100 million US dollars. You are trading with 100 million US dollars. Will you just be buying and be selling at impulse like this? No. So the best way you can approach the market is to know what is happening on a global standpoint. From the fundamental standpoint, the sentiment standpoint, then by the time you get to the technical standpoint, you want to trade in direction of the trend. And believe me, the real trend of the market is what the weekly chart is telling us. If it's giving us a bi-directional bias, that is the trend. Because by the time you go to the monthly, you will see that is the trend. The trend is what the monthly is telling us, but a lot of time we don't want to hear monthly time frame. So by the time you break it down and come to the weekly chart, whatever predominant movement you see on the weekly is the trend, is what you should follow. Any other thing, you are trading against the trend. You get that now? So this is how we view the market at Potential Miners International, because we believe that we want to build community of forex traders, and that will trade the forex market for a long time. And we are here. It took us over 6 years before we can come up with our system. So we are here for a long ride in the financial market. And of course, we encourage you to be a part of our community. Learn how we overview the market. Is for free. Just listen to how we analyze the market. Then you begin to pick what you feel is necessary to adopt or to adapt into your own trading system. Then you will now begin to see changes as you do so. Until I see you in the next video or next analysis, I remain Mr. Kimbode, the King of Waves. Thank you for listening. God bless you.